Fabulous. Good morning, everyone. Thank you so much for coming for this amazing conversation that we're about to have with the Senior Deputy Governor from the Banque of Canada. I'm Brad Perry. I'm the President and CEO of the Calgary Economic Development, as well as the Opportunity Calgary Investment Fund. And before we begin, I'd like to do a land acknowledgement. In the spirit of respect, reciprocity, and truth, we honor and acknowledge Mohintous, the traditional Treaty 7 territory and oral practices of the Blackfoot Confederacy, the Siksika Nation, Kainai, Piikani, as well as the Stoney Nakoda and Tsuut'ina nations. In the spirit of reconciliation, we also acknowledge that we live, work, and play on the traditional territories of the Blackfoot Confederacy, Siksika, Kainai, Piikani, the Tsuut'ina, the Stoney Nakoda nations, the Métis Nation Region 3, and all people who make their home in Treaty 7 region of Southern Alberta. So again, thank you for joining us today, and again, thank you to our special guest today, Carolyn Rogers, the Senior Deputy Governor of the Banque of Canada. Thank you for joining us, Carolyn. You know, one of the things we do at Calgary Economic Development is really about facilitating important conversations. And I honestly couldn't think of a more important conversation today with the Deputy Governor than what's happening right now. If you look at the announcements that were made a couple of days ago, if you look at what happened in Europe this morning with the interest rate hikes, this is a very timely and significant discussion, and we're thrilled to have you here. So thank you again for making the time. This is also one of the first in-person speeches that the Deputy Governor is going to give, and frankly, she's been at the bank since last December, and prior to that, she was working in Europe. She was part of the, working in Basel on the, I can't remember, sorry, Carol, I just blanked out. She was working with the Deputy Governor of Bank and first major speech. You know, private sector. She was, sorry, it was the Basel Committee on Banking Supervision before coming back to Canada. You know, and again, this is such an appropriate place for the Banque of Canada to have this update for us. Our economy is growing. We're a future-focused city. We're an engine for national growth, a global financial center, a community of committed people who are really, really here to help solve global challenges. And so we're thrilled to be able to have this conversation today in these unprecedented times. We're fortunate to have the insights of the Senior Deputy Governor today, and I want to ask you to please join me in welcoming Carolyn Rogers to the stage. Sorry about that.
Thanks, Brad. These days, I can barely remember what I was doing 10 months ago either, so don't worry about it. It was the Basel Committee on Bank Supervision at the Bank for International Settlements. So, but first, well, good morning. Thanks for being here. Thanks for the opportunity, the invitation to speak with you today. As Brad said, this is my second public speech since joining the bank's governing council mid-December of last year, and I'm really pleased to be out west this time. I grew up in Western Canada, and over the course of my career, I've lived in every province from Manitoba west to BC, including spending some time here in Calgary. And harvest time is approaching, which is my favorite time to be out west. It's a time of year that holds a lot of promise and brings back many fond memories for me. The best part of coming out to make these speeches is spending some time hearing from people like you, so I'm really looking forward to the next day or two where I'll have a chance to hear perspectives from business leaders like yourselves on the Alberta and the Canadian economy. But first, I'm here to offer you some of the bank's views, particularly on the economy and on monetary policy. I plan to cover three things this morning. First, I'll spend some time discussing our current outlook on the Canadian economy and on inflation specifically. The Consumer Price Index, the CPI, was 7.6 in July, down just slightly from June's rate of 8.1%. While it looks like we might have seen the peak of overall inflation in Canada, inflation excluding gasoline prices has continued to rise and broaden across goods and services. There's also some uncertainties, particularly in global commodity markets, that could set us back. And although most days it feels like the pandemic is in the rearview mirror, we're heading into winter, and that means more time indoors. If we've learned anything in the last 2 years, it's to expect the unexpected. Of course, the second thing I want to talk about is our recent rate decision, our decision yesterday. We raised the policy interest rate by 75 basis points, and of course this came on the heels of July's decision to increase the policy rate by a full percentage point. In total, the bank has increased the policy rate 3% since March. I'll spend some time explaining why we have chosen to front-load rate increases and why we think this has been and continues to be the right response to the current underlying causes of inflation in Canada. The third and final thing I'll spend some time on is the path forward. I hope to give you a sense of the things that the bank will be monitoring closely, the signs we'll be looking for to guide our next decisions in the months ahead. Monetary policy takes time to affect the economy. The decisions the bank makes now and the ones we've made in recent months will take up to 2 years to have their full effect on inflation. But in the meantime, there are indicators we look at along the way to help guide our decisions, and I'll try and shed some light on those today. I'm going to begin with how our views on the economy have evolved since July, because that'll help me set yesterday's decision in context. Let me start with inflation. Global supply challenges and elevated commodity prices continue to contribute to inflation here in Canada. In addition, demand continues to outstrip supply in many parts of the Canadian economy, and short-term inflation expectations of Canadians remain high. As long as that continues to be the case, there will be upward pressure on prices. Many Canadians experienced this over the summer. We all tried to make up for the last 2 summers of missed vacations and family gatherings. They faced limited options and higher prices when it came time to book campsites, car rentals, hotel rooms, plane tickets, even dinner reservations. And price pressure is not limited to discretionary items like vacations and restaurants. In fact, some of the biggest price increases we've seen have come on things like groceries, gas, and rent. These are all things Canadians need to buy on a regular basis, so it's impossible to escape the frustration and the stress that inflation brings, especially for those who are living on low or fixed incomes. High inflation is affecting businesses too. Inputs, things like raw materials, intermediate inputs, and labor are all more expensive. While businesses can try to pass on higher input costs by raising prices, inflation creates uncertainty that can affect investment decisions. In the long run, this puts downward pressure on productivity, and it prevents businesses and the economy as a whole from growing. Although CPI inflation came in slightly lower in July, this drop was due almost entirely to gasoline prices. If we exclude gas prices, inflation actually increased and spread across components. In fact, more than half of CPI components grew more than 5% in July, and the bank's measures of core inflation continued to move up. All of them were at or above 5 in July. This shows us just how strong underlying inflation remains in Canada. Turning to the broader economy, it's evolved largely as we expected it would when we published our July monetary policy report. Consumer spending was very strong in the second quarter, with a recovery in hard-to-distance sectors boosting spending on services in particular. Early indicators, things like restaurant and hotel reservations, suggest that demand for services will remain strong in the third quarter. Housing resales have dropped from unsustainably high levels during the pandemic, and house prices have been adjusting downward, with the largest price declines occurring primarily in the areas of the country where they increased the most over the last 2 years. On the business side, a surge of imports of machinery and equipment in the second quarter points to strong business investment in the second half of the year, and the export outlook remains positive too. Alberta's economy has certainly benefited from this strength, as well as from higher oil prices, both of which should boost investment and exports in energy and other commodity services. The labor market remains very tight. The unemployment rate is at an all-time low, and we're still seeing significant labor shortages across most sectors. With more than 1 million current job vacancies in Canada, demand from employers remains very high. Softer global demand for goods is contributing to some improvement in supply chain bottlenecks. Global shipping rates have declined considerably in recent months and are now about 50% off the peak in September 2021. and supplier delivery times and backlogs have continued to improve in July across most regions in the world. While the global picture is encouraging, supply constraints remain widespread here at home. Canadian businesses tell us they're just not yet seeing major relief on the supply front. Taken together, the data over the past 2 months point in one direction. The Canadian economy continues to operate in excess demand despite the recent pullback in housing, and inflationary pressures are increasingly broad-based. This leads me to our decision yesterday to raise the policy rate by 3.25%. This is the 5th increase to our policy rate since March. The speed and the size of these rate hikes have been unusual, and we know Canadians are anxious to know whether they're working as intended to bring inflation down. We also know that for many Canadians, higher rates are adding to the burden they're already facing with high inflation. But raising interest rates is necessary to bring inflation down. Higher rates make borrowing more expensive and savings more attractive, leading consumers and businesses to spend less and save more. As people spend less, overall demand in the economy declines, and this will give supply a chance to catch up. Because we're in a period of excess demand, we need a period of lower growth to balance things out, to bring demand back in line with supply. The reduced spending that results from this rebalancing will ultimately help us lower inflation. Monetary policy works a bit like a chain reaction or a sequence of events, and that sequence takes time. Both history and research tell us that changes to the bank's policy rate affect different households and different sectors of the economy differently and at different speeds. If you're making a big purchase or an investment, one that requires a loan, you'll feel the impact of higher rates almost immediately. And the sectors that are most sensitive to changes in interest rates are the ones that cool first. The housing sector here in Canada is a clear example of that. Most of us take out a mortgage to buy a house. An increase in mortgage rates may cause us to delay a purchase or purchase a less expensive house. This leads to a slowdown in housing activity, and as housing activity slows, people tend to spend less on the things that go with houses, furniture, other housing-related goods. On the other hand, it takes longer for monetary policy to bring down price growth in other goods and services, especially in services, because they're typically not related to borrowing. Instead, they adjust over time as spending overall moderates. Let me focus in a bit now on our deliberations leading up to yesterday's decision. Of course, Governing Council discussed how the economy had evolved since July. We noted that while Canadian and global economies are showing early signs of slowing, the Canadian economy is clearly in excess demand. GDP growth in the second quarter was slightly weaker than we predicted in July, but consumption and business investment grew at a significant pace. Labor markets remain very tight and inflation is broadening. With short-term inflation expectations remaining high and all three of the bank's core measures of inflation moving up, we discussed the risk that ongoing inflation becomes entrenched. If that were to happen, higher inflation becomes self-fulfilling and a damaging cycle would be set in motion. We want to ensure this scenario does not materialize. The economic cost of restoring price stability will be much higher if it does. This led us to our decision to raise the policy interest rate by 75 basis points. By front-loading rates now, we're trying to avoid the need for even higher rates down the road and a more pronounced slowing of the economy that would go with it. Given the outlook for inflation, we continue to judge that policy interest rates will need to go higher still. As the effects of tighter monetary policy work through the economy, we'll be assessing just how much higher rates need to go to return inflation to target. Let me turn now to the path ahead. So going forward, our focus will be to judge how monetary policy is working to slow demand, how fast supply challenges get resolved, and most importantly, how both inflation and inflation expectations respond. I'll spend just a couple minutes on each of these three things. On the demand side, we'll be keeping a close eye on how global developments and commodity prices affect exports and business investment and how this translates into pricing decisions. As higher inflation and interest rates constrain household budgets, consumer spending should moderate in both goods and services. However, we know Canadians have accumulated extra savings during the pandemic, so there is a risk that consumer spending has more momentum than we suspect and might make inflation a bit more persistent. As labor demand eases from excess levels, pressure on wages and prices, and therefore on inflation, should recede. And of course, we'll continue to monitor the adjustment in housing activity and prices. On the supply side, unexpected global events could further disrupt supply and push prices up even more. We'll be watching to see if supply disruptions are improving, especially in hard-hit sectors like motor vehicles. Will improvements to supply chain bottlenecks continue, and how quickly will this translate into an easing of supply constraints and therefore lower costs for Canadian firms? Similarly, the bank will continue to monitor a broad set of indicators to see if labor shortages are subsiding. Finally, as demand and supply come back into balance, we'll examine how inflation and inflation expectations respond. This includes looking at the near-term momentum, in particular our measures of core inflation, to assess how broad and entrenched pricing pressures are. Meanwhile, survey results will help us see if the short-term inflation expectations of consumers and firms are coming back down. This will be a really important sign that monetary policy is working and Canadians are beginning to feel some relief. Given the lag between changes in interest rates and the impact on inflation and the considerable amount of uncertainty surrounding the outlook, getting inflation all the way back to 2% is going to take some time. We also know there could be bumps along the way. This is why our ongoing and careful assessment of the economy and inflation is so important. We remain resolute in our goal to reestablish low, stable, and predictable inflation. Canadians should be able to plan their spending and saving decisions without having to worry about the rising cost of everyday essentials. So let me conclude by going back to where I started, harvest time in Alberta. As a kid, I spent a lot of time on my grandparents' farm, and I remember my grandfather telling me he needed 3 eyes at harvest time. One for the weather, one for the calendar, and one for the crops. And I also remember long days and long sleepless nights until the crops were off the field. It feels a bit like that at the Banque du Canada these days. We have a careful eye on many different things. We have a lot of work ahead of us, and we will not rest easy until we can get inflation back to target. We're determined to get the job done.
Thank you so much. That was fantastic. Appreciate that. So now we're opening the floor to questions, both from the floor. We have people online who are submitting questions. If you do have a question, we have people with microphones who are able to take your questions. So do I have anybody on the floor before we go to the online questions? Not yet. So, Governor, Deputy Governor, sorry.
You just promoted me.
Deputy, I promoted you. Yes. After that speech, why not? You mentioned in a speech in June, you said we need better transparency about climate exposure by businesses and financial institutions. We also need clear transition plans by global policymakers. Together, these can help mitigate the risk of disorderly and painful transition. Yep. That hurts both our financial system and our economy. So are we still seeing the signs of a painful and disorderly recovery?
Well, I think the war in Ukraine, I think, has caused a lot of reflection on the transition path. I mean, we were really focused before then on an aggressive transition path. I think what we've seen now is most countries around the world are reflecting on energy security as well as the transition path. That doesn't change the fact and the points that we made earlier. It is the bank's very strong view. We put out a paper on this earlier this year. We did some work with one of our federal partners, the Office of the Superintendent of Financial Institutions. So it's our very strong view that getting out ahead of this transition, getting policies in place will make for a much smoother, more planned transition. What we don't want is to see sort of dislocations, unexpected bumps along the way. So we continue to think that that transition's necessary, but it certainly has been complicated by what's going on in Ukraine.
Thank you. I did warn Carolyn that this group was not shy, but apparently you're making me look bad because I'm not seeing any questions right now. I have one question at the back.
Hi, thank you for the speech, first of all. And if you don't mind, I have 2 questions. Okay. First question is, you mentioned that this is going to be a 2-year plan, and what metrics will be used to see that we're on plan and we're not getting away, and if something happens, to go back on plan? And then the second question is, you mentioned that there's a shortage of employees. So my understanding is that there's going to be an immigration changes for more people to come into the country. Mm-hmm. And as an immigrant myself, I was wondering, how will higher interest rates impact the decision-making of those immigrants coming into the country? Will they be more open, or my thought is maybe they will be less open to coming here and then working and spending more interest?
Okay, that's an interesting question. Well, I mean, what I would say is inflation is a global phenomenon right now. So I think it's something that's happening in all parts of the world, and in fact, I think the inflation rates in Canada are lower than some of the major jurisdictions in the world. Whether that affects the decision that people make on immigration, I don't know that I have much of an insight on that to offer. But I will come back to your point about immigration being one of the sort of relief valves to the high level of the pressure in the job market. That is the case. Immigration has fallen off in the last couple of years. We do expect, as it comes back again, it will provide a bit of relief in the job market. To your first question, I mean, I guess I would clarify what the 2 years is a reference to is what we know is that it can take up to 2 years for the full effect of monetary policy to occur in the economy. It has to work its way through. It's that chain reaction or sequence of events that I described in the speech. So I don't know that we have a 2-year plan. We do have. We are aware that the decisions we're making now won't have an immediate effect. They will take some time. So that's why we I laid out sort of the number of indicators that we look along the way to see whether things are evolving as we expect.
Thank you for that. We have a number of questions now. There we go. One over here first, and then we have 2 on this side.
Hi there, and thanks for your comments today. I've really appreciated them. I'm wondering if you can expand a bit on the notion of inflation becoming entrenched. In particular, you seem to think we're not necessarily there, but seeing inflation hit the service sector so strongly, I'm wondering, A, why you don't think we're necessarily in an entrenched space yet, or maybe there's some gradient to unpack, and B, if it does become entrenched, how can we see the plan evolve from there?
Sorry, the last part of your question?
Yeah, how would the plan evolve to fight inflation if you see it or perceive it being entrenched?
Okay. Well, so to the first part of actually, let me back up and just maybe elaborate on this point a bit. I mean, I know there's been some discussion about this lately. So what we've got now is a combination of high inflation, excess demand, and a super tight labor market. And what happens in that environment is employers are really focused on attracting and retaining the employees they need. They're looking at the excess demand they've got for their products or services, and they're trying to hire the people to keep up. And that can lead to wage pressure. That's completely understandable. Employees, on the other hand, are looking at the same very tight labor market, and they're looking at the effect of inflation on their budget, and they're saying, look, I need a raise. So also completely understandable. It's not the Bank of Canada's job to provide advice on wages or prices. That's not our role. But it is our role to make sure people understand how those decisions affect the path of inflation. The scenario that we're worried about, what we call entrenched inflation, is when businesses and consumers start to look at the current rate of inflation and they make the assumption that that's here to stay for the long term, and they start making decisions with that assumption embedded. If that happens, that's what we call entrenched inflation. What happens in that scenario is inflation becomes sort of a self-fulfilling prophecy. It becomes, you know, a sort of wage pressure becomes sort of an independent sort of source of inflation. We want to avoid that. To your question of what happens, monetary policy has to tighten a lot more to get inflation back down when you've got that kind of spiral happening. So, you know, that's why we're focused on avoiding it. The front loading of interest rates is one of the key strategies we think that will help us avoid that. I think the other question you had is, how do we know that it's not entrenched yet? We do a lot of our own surveying with businesses and consumers, so we're getting real-time feedback on what they see. We've also been looking at some of the private sector surveys too. Certainly, inflation expectations are up. That makes sense. Inflation's up, and it's been up for a while. You know, ultimately, the best way to get inflation expectations down is to get inflation down. So that's what we're focused on doing.
Thank you. We have another question. This gentleman right behind you, Sean, I believe. Who was? There we go. Sorry, thank you.
Good morning, Tom Holloway, University of Calgary. Your own bank and global central banks seem to be quite bought into the idea of front-loading and mention research about how front-loading is better. Can you help us understand that research a bit? Maybe it's from historical experiences or something like that. Thank you.
Yeah, I mean, I think you probably saw the ECB announcement today. I think they used the same term. You know, there was the research that most of us are referring to was done actually by the Bank for International Settlements. It's online. You can have a look at it. I think a big part of it is back to the question the gentleman asked me just before, which is making sure people have a sense that the bank is focused on getting inflation down, trying to stave off that sort of expectation spiral that we're seeing, trying to bring demand down quickly so that it doesn't run too far ahead of supply. The research that we cite is publicly available. I can, if you'd like, afterwards I can point you in the direction. And we can debate it if you like.
Fantastic, thank you. I think Deb Yedlin, President of the Chamber of Commerce, has a question.
Thanks very much, and thanks for the comments. I guess just to piggyback on what was just asked, I mean, that front-end loading, what are the risks that you overshoot? And you actually, you know, economic growth is compromised more than you expect it should be. And so that, I have one question. The second one is, you mentioned the amount of savings that that are sitting on the sidelines still, and how, do you have a sense of the timeline of when that might be dissipated? What kind of impact could that have? Could that offset some of what we're talking about right now from an economic growth perspective, because people will continue to spend?
Yeah. Well, I'll take your second question first. Yeah, I mean, Canadians have accumulated a lot of what we call excess savings more than they normally would have over the pandemic. And as I said in my speech, you know, one risk to the outlook is that sort of props up high levels of demand and spending longer than it might otherwise in a rising rate environment. That would sort of make inflation a bit more persistent. We've been watching it for a while now. You know, we keep thinking Canadians will draw it down. We haven't seen a lot of that yet, but you know, the effective rate increases are just starting to take hold too. So, you know, we're watching it closely. Back to your first question. I mean, there's a lot of risks. We have said this from the beginning. This is it's a delicate balance. The economy right now is very strong. There's a lot of excess demand. Unemployment's at a record low level. So, you know, we think there is room to cool demand and keep the economy in a positive state of growth. Is it tricky? Absolutely. It's absolutely tricky. Yeah.
Thank you. Do we have any other questions right now? One of the questions that's come in was something you mentioned in one of your previous speeches, which is to say that the Bank of Canada can be a little bit mysterious. Can you shed a little bit of light on that mystery?
Well, as some of my friends will say to me when we get going, stop talking economist to me and start talking English. So, I think it's, there's parts about, particularly about monetary policy, I think, that are not intuitive, the idea that, a lot of people are saying to us now, help us understand how increasing the cost of my mortgage, increasing the cost of borrowing is helping me with the cost of living problem I have with inflation. I mean, and I completely understand that question. It's not an intuitive thing to understand. So, I think the bank puts a really high priority on communicating, helping Canadians understand monetary policy. We've always done that. When inflation is 2% for decades on end, as it has been, it's hard to get people interested in wanting to understand monetary policy. They don't need to know how it works. They just know it does. And so they've got other things they are interested in knowing. Right now, people are really interested. And so we're putting a lot of effort into being less mysterious, into making sure that any Canadians that want to engage with us, that want to understand monetary policy, have the chance to do that. We think we're the right place to get information, and so we're trying to put a lot of information out right now.
We were having a conversation before about the distribution mechanisms around getting that information to a younger audience.
Yeah.
Can you talk to us a little bit about, I know we've seen some social coming out of the bank now, a little bit of that. Can you talk a little bit about the thinking around how to get that message into sort of our youth's hands so they get a better understanding?
Yeah. Well, I mean, that's exactly it. Nowadays, social media is a place where some people exclusively get their information. So I had a conversation with my nephew, it was around Christmas time, and I said something about the Globe and Mail, and he said, "What's that?" So, it's just, so yeah, I mean, we need to go where Canadians are, and Canadians of all stripes, of all generations, of all interests. So we have been ramping up our social media campaign. We've been bringing in more expertise in that area. We've been trying to leverage some of these, well, for us, I'd say new tools. I think, Twitter's hardly a new tool, but we're trying to put more effort into our social media campaign. We're trying to meet Canadians where they are.
Fantastic. I think Mr. Lougheed has a question.
Well, first of all, Joe Lougheed, Chair of Calgary Economic Development, and I want to thank everyone for being here today, and thank the Senior Deputy Governor for being here, and welcome back to the West. My question, of course, monetary policy and interest rates are a pretty blunt instrument,
Yeah.
and we're a very large country. How does the bank look at regional economic perspectives in setting these factors? And certainly you'd have a lot of data on the forecast and prospects for the West and Alberta in particular. So what are the bank's views on Alberta and our economy in the medium and longer term?
Yeah, well, I mean, Alberta is and always has been an engine of innovation and economic growth in Canada. So, we were having this conversation earlier this morning. That continues to be the case. I'm glad that's your phone, not mine, because usually I forget to turn my phone on. But you're right. I mean, monetary policy is a blunt instrument. We have one policy rate. We don't have a policy rate for different provinces. We know that. The best thing we can do to make sure that we're getting a full picture of the Canadian economy is this kind of thing, to get out in the regions. We have regional offices across Canada. Calgary is actually, I think, our largest regional office. We have a big team here. I'll be spending the next couple of days, as I said in my speech, hearing from people like you. That's a huge part of what goes into our decisions. We take in all kinds of data and analysis and models, but a big part of the presentation the Governing Council gets on every single decision is our regional staff come out and say, hey, here's what's happening in Alberta, here's what's happening in BC, here's what's happening Montreal. We always take that feedback on board. It's very important to us.
Thank you. We have one question at the back.
Yes, thank you. I just have a quick question. So, in the last decade, like the Canadian dollar has a strong correlation with commodities, especially crude, right? And that's what kind of was our offset for inflation, right? So, obviously, as we know, the spike in crude prices back in February during at the start of the Russian-Ukraine conflict, there hasn't been that correlation of rising the Canadian dollar against the U.S. greenback. With the further tightening of the monetary policies, do you think we're going to see an increase of our currency going up, or?
Yeah. Well, I mean, the first thing I'd say is the bank doesn't forecast on currency. That's not something we do. But what I would say is we've observed the same thing you're describing. I mean, normally rates would go up and price of oils go up. You would see some investment coming into Canada. You would see the Canadian dollar tick up, and it would provide an important buffer on inflation. We haven't had that buffer. So, I was reading some commentary yesterday. There is an expectation for the Canadian dollar to go up. We'll see if that happens. It would be nice to get that buffer.
We have one question over to the right.
Thank you. Welcome to the West again, Deputy. I'll use
Thank you.
just Deputy.
That's good for short. Yeah.
Thank you for speaking. Maddie McMillan, she, her, they, them. I work with the Petroleum Services Association of Canada, so we know a lot about energy, labor shortages, and supply woes. You mentioned about 3 I's with Gramps in eye on the weather, calendar, and crops. I was wondering if you could speak on the eye, on a 4th eye on the horizon. You have a room full of smarties listening to a smarty. We're not the only country facing inflation, and we've spoken domestically. What do you see from what you've seen and read? What do you see puts us at competitive advantages or opportunities for the smart folks in the room here to go and tell all their buddies to go and act and fight inflation? Thank you.
Well, I mean, I think, as I was saying to a previous question, inflation's a global phenomenon right now. Almost every country is dealing with at least some level of inflation, and lots of countries are dealing with the levels of inflation higher than ours. In most cases, those are countries that import some of the things that we have here at home. So one of the advantages Canada has right now is we produce the things that are in short supply in the world right now. We don't have to import them the way other countries are, and that's certainly giving us a bit of an advantage, both sort of on the economy as a whole and on inflation.
Thank you. And I think we have time for one more question. I believe, Deb, you have one more question for us? Oh, was there somebody else as well?
Sorry, this will be
I can
quick.
do one more after this.
Okay.
When inflation started to run, a lot of people were looking at what was going on and saying, well, this is supply, it's supply chain driven. It's the destruction of the global linkages from a trade perspective. It's transitory. In your perspective, when did transitory become, we have to start raising interest rates because this is actually more than something that is passing, sort of coming out of the pandemic?
Well, that's easy. That was March, right? That's when we raised interest rates. Yeah, I mean this.
What was the inflection?
Yeah. It's difficult for me to say because I was in between jobs around, I think, the time that a lot of this, so to speak on behalf of the bank on that question is a bit difficult for me. What I can say is central banks around the world took this position on transitory because that's what supply shocks usually are, right? Usually supply shocks, even if they last a while, they do usually dissipate. And what we've learned over the years is if central banks react too quickly to those supply shocks, you create turbulence. You can do more damage than good. And so I think that was the thinking around the supply shocks. I think, what we have learned since then is when those supply shocks come as a result of a pandemic, when they're that widespread, they're that global, they're that disruptive, and then they're followed very quickly after by a war in Europe, they're very persistent. So, if it's clear in our speech and in what we're saying, we do still expect these supply shocks will dissipate over time. But, I think when we were using the word transitory, people thought, well, they're going to go away soon, right? And so, we're off that message for sure. Yeah.
One more question, and someone's just going to bring the microphone right there. If you could just stand up, please. Thank you.
Hi there. I just had a question a little bit more about how you view monetary policy along with fiscal policy. We're seeing GST rebates come out. You've had the UK come out potentially with an affordability of energy. But how do you look at that from a monetary policy, especially when you're raising rates?
Yeah, that's a really good question. So, you know, people are really concerned about affordability. And so there is a lot of pressure on governments to help, particularly people with low income, with what is really a lot of pressure on affordability. So we understand that. Governments are weighing a lot of priorities. They have to balance a lot of things. You know, we do need help on the fiscal side to get inflation down. It does need to be a joint effort, but we completely understand that there's some pressure on affordability. Ultimately, our job is inflation. That's where we're going to stay focused. And we're going to get inflation back to 2%.
Fabulous. That's all the time we have right now. So please, ladies and gentlemen, for Carolyn Rogers,
Thank you.
Thank you so
Thanks
much
for the
being with us.
questions.